There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits, or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
So welcome everyone again to the 16th of October software strategy session. My name is Steve Vettel, just going through next week's Forex calendar. Tomorrow looks like due to participate in virtual accounts under global economic uncertainty. Yeah, so the key thing with any of these virtual whatevers from central bankers around the globe, you always want to pay attention if there's going to be a Q&A session, right? Because a lot of times if there's an unscripted Q&A session in any of these meetings or any meetings that are hosted live, always have that much higher level of risk that could be brought into somebody stepping out of line with what's going on. We've had, at least in this country, in the last month, we've had some disruptions in the Fed. I had a couple individuals that, allegedly were trading their own accounts as regional Fed governors, which is a big no-no due to Fed and Treasury policy. We'll see if anything shakes out from that. But we've had a couple of dissenters, especially Bullard, who's not a voting member of the FOMC anymore, but these kind of sort of out of line, if you will, just think of like a military, parade or what have you, and a particular military person falls out of line, right? And it's different from what you would expect in terms of any type of pageantry or anything that goes with the normal course. So an individual or a group of individuals starting to dissent or step out of line, if you will, can bring a lot of volatility to especially markets when they are in a very bubblicious nature. So everything from crypto to equities to real estate to hell, even the used car market, has seen significant appreciation due to supply chains, disruptions in the pandemic, obviously, stuff that I think we're all as human beings adapting to fairly well over the last 12 months. Maybe much so than, I should say, our adaptation has been probably much more advanced than any other major event, in the past 1,000 years. A lot of these pandemics that took place, it just took, in some cases, decades for to pull out, from some of the devastation, like the Black Plague and some of the other stuff I've studied in the past. So I think we're making some pretty big advancements, which will continue down the road. So be aware of any Fed folks stepping out of line. On Monday, we've got Aussie-based policy minutes. It's just going to be a review of the last time they had met. You can always click on the X and see what's going on. Tuesday, CPI GPP. We have some CAD CPI, so it'd be interesting to note with the changes in our price index here, if that will sort of spill over into other areas. So if you click on the X, you can look to see what the forecast is. So this was a surprise number, right? So we had a couple of surprise numbers, but not August. Right, so that's not really a trend, in my opinion, of transitory inflation, but this country shows a completely different story of all kinds of costs going up, from core raw materials to energy, obviously, and some core commodities as well. So keep in mind a lot of this AUD stuff is, really heading the calendar up a bunch. Be aware of that. And then on Friday we have manufacturing. Not as concerned about that. This currency report doesn't really carry the red folder impact historically that it says, so that's something I'd be too aware of. So all in all, I don't really see, outside of some sort of black swan event, which I did talk a lot about it. I closed the AP window down, but the post that I did, and maybe I should just log in and show you guys. See if we can get back in here. Because I think this is important. So you can always, if you just want to see what's going on, you can click on, the trading risk management tags, or you could just go to my page or my group, whatever you want to do. See everything I've posted. It's just specific to me. But this was a client. Sometimes I send out emails to clients. So I've got a lot of clients all over the whole world. But this particular one was just really it's been not really that talked about a lot, but I really think this China problem could present some waves. It could present some small ripples, right? I talk about that sort of building into a tsunami, but there's a lot of problems going on in this country. And the concern for American and European corporations is that if the apple cart, if you will, continues to limp on a wheel, or if the wheel breaks and the apple cart completely tips over, it's going to cause a lot of disruptions in a lot of businesses. And I think that could certainly carry over into everything: commodities, currencies, certainly the prices of the different stocks in the equity markets. So these are the concerns that I see, that I talk a lot about. I'm not the only one echoing this. Kyle Bass, a number of big hedge fund guys, have been quite vocal about this that I follow on Twitter, and you can too. So I think it's important to just sort of keep an eye open for this. The level of what they call metastasization, just like you have with the cancer, can be really slow, right? So even though the first wheel sort of gets a crack in the spoke of the apple cart, it could not actually fully break for a year, right? And what if it, took 3 weeks or 3 months? It's really hard to tell because we cannot get good full information out of China. So you're really essentially left to, sort of lean on, as I do with about 4 or 5 big guys I follow, as I consider them to sort of be my, my sources, right? And they have an excellent read, in my opinion, on what's going on. So if I continue to see things really ripple, or bigger waves into our area, being obviously the U.S. and Europe, I'll let you guys know. But for now, it's worth noting. What else do I want to say? That's pretty much it for this. Take a look at some of what's going on. So I noticed we're starting to see in the Arrow Room, and certainly other traders coming aboard that may or may not participate in all of the EAs running their accounts, or may accept trades. But well, a lot of them that come aboard, they trade separately from everything we're doing at Auvoria, right? So they may trade these indices, they may trade stocks, ETFs, options. They may trade the futures markets like I do. So I'm trying to show a little bit more of what's going on in broad indexes, because I think it's going to help you guys get a better feel. So just take a look at the S&P 500 real quick. If you ever see this ES2, this essentially is what's called a continuous contract for the front month. That is the S&P 500. But it's probably easiest from an analysis standpoint to just look at the markets using the SPX index. You can also use the spiders. They both have super liquid markets. I like the spiders because the volume, this is the single most traded thing on this planet in terms of volume. So typical day, like a high day of volume, bring the metrics down. Looking at a high day of volume on the S&P, there's 166 million shares traded in the spiders, on which was a very volatile gap down day of the 20th of September. So when you're doing analysis, I only like to look at what the current range is in this upper area. So let's take a look at just that. And we usually want to start off with however many candles put us up in this area. So I think probably what right here, 25th of June is when we first traded up into this area. And this is the exact same kind of analysis that you can do on any market that has good aggregated volume on it. You just want to see only the data that brought us into this range. And you can certainly argue for 22nd of June. And if you want to fine tune it, you can always just key it in. We're starting 22nd of June. You can see how the center point of this, which is this red line right here, this is the volume profile. This is an aggregate on a profile of all the shares that have traded in a central point. And then you have the value area low. Notice how the value area low is completely capped. Forget about these tails on these candles, right? This is a daily chart. But just look at the value area low. So this is 70% of the volume that has been traded in this range is considered the value area, right? So you have a higher low, and then you have all kinds of nodes that go in between, which I'll show you. But just looking at the bottom here, this is a value area low. See how it's completely capped this move. So a lot of times if, there's Bollinger Bands and there's certainly other stuff down here where we saw previous flash lows. There's a lot of reasons or areas of confluence as to why we're being held at this point. And this whole area poses, a significant support at this point. And now we've gapped and run back up. So our gap back ups, these are one time framing gap ups, right? So it's always important to take note that we've gone right back up to the top of this range right here at 4450. It's like the 4460 area. You can jump over the S&P if you want to see the broader index, but essentially it's this whole 70 zone that we've gapped right up against. This is the bottom or the shoulder line, if you will, of this head and shoulders pattern. So typically, especially since it's probably also the value area high, huh? Actually, let me go back to the spiders. I like that better. So value area high. Actually, let me just do the date. Sometimes it's hard to get this on point. That should be about right. That's the date range I want to see. So yeah, here you go. We're basically slightly above the value area high. So arguably extended, not from a Bollinger Band standpoint, but we've completely traversed the profile. So one of the other concepts that's important to note is that, maybe not the easiest to see here, but if you can't get through particular area, let's say the value area low was down a little lower, which should be if this chart was expanded out to June 22nd. The value area low is down here. We can't get below this area. Typically, markets will auction back to the highs of the value area. So it'll oftentimes go back up to the value area highs. So those that understand auction market theory, which is a concept I've been kind of trying to overlay a lot more complex of a technical analysis, because it brings in a whole different set of variables that one needs to be aware of, and it's all volume based, right? So it's not based on price action. It can be based on time, which is not shown in TradingView, but we can at least show you the volume, get you more sort of plugged into that. This isn't the best system to look at it on. So what I've done is I've taken a couple of screenshots from my IRT software. So what you see here is a 240, essentially a 4-hour chart on the S&P over, how many dates we're looking at? I don't think I cut the dates off at the bottom, but it's a 4-hour chart over a long period of time. This is the S&P 500 December contract. And you can see that what I choose to do on the software is to aggregate the volume that is traded over a long period of time for the entire range, right? Not something I wish, something I essentially wish I could do in TradingView, but I can't do the kind of aggregation that I want. So a lot of people say, well, you know, if you're looking for high and low volume nodes, then look at the air pocket that is right down here, right? So why did we trade to this point and turn around? Well, it was the value area low of this entire zone, right? But it was also there was a couple of bunch of missing notches down. I don't know if you guys can kind of see this, but there's just not a lot of data. So what we call that missing notches, we call that low volume nodes. I mean, call it what you wish. You just want to be able to see that there's just not a lot of auctioning that took place in an area. We went down, auctioned, filled in arguably a couple of those notches and found buyers. It brought us back up, right? So this isn't accurate as of Friday. Okay, so it'd be a little bit higher, obviously, but I snapped this towards the middle of the week. And this is Linsoft's IRT. So this is Bill Linsoft's software that a lot of futures traders use to aggregate both time and volume. So it's a different way of looking at it. You can also break them out. This is actually a 3-minute chart. This is something more for traders, but you can break this out into sessions. So we have, this is a central time-based snapshot. You can see the session started at 8:30, traded to 2:15, 2:30, just depends on, and then you have, you know, a period where the futures market's actually closed for a while. So, but what you can do is you can see all the volume that's trading, and it'll put, which is where these blue lines are, the value area highs and lows over each day. So you can break it out per day. You could do the exact same thing with currencies, provided you've got a good data provider bringing data into whatever your system is. So if it's TradingView, pretty good data, you know, probably much better data with the major currencies than a lot of the minors or the crosses, right? Which is, you know, something I'm constantly harping about, but it's important that quality data that is not fraught with errors is allowed. And the other cool thing is with the Linsoft, you can actually clean the data. So I could do what's called a scrub inside the software to actually clean the data, so that the point is I'm getting super clean readings on what I'm seeing, right? Now, we were forecasting a little bit of a down and then to rip up with some of our analyst guys that we trade with from just the patterns that we saw. But cool thing is you can look to see, you know, where are the areas of you know, like a zipper zone or a low value area, low area like here, or high volume areas or the value area high. So these nodes are points where price has a tendency to want to auction back and forth towards. Some have a higher level of magnetism than others. So just touching on the subject with you guys, you don't have to master this. It's a different way to analyze markets, and it is, you know, basically with price action and utilizing market profile, which you guys know that I'm sort of well known for my education and teaching in this category, which unfortunately takes a long time to learn. So with that being said, I'm not going to show all those other charts, but let's just rip through real quick. Reset this. We'll look at daily charts on, start off with the dollar. So this puts it a little more in perspective here. So you're probably going to take a look at a weekly to start. So we had our run from the pandemic high. This is a sort of a reactionary flash high. Basically 10 full dollars down to our lowest zone, actually a little more than 10, And now we're back up against a big zone, arguably a very big zone. And so far, 3 weekly candles have printed with wicks up in this area against longer term moving average lines. You can see both the yellow and red lines here. And we're holding. So far, we're holding. Can't say that's going to be the case next week. There was a big event, obviously pandemic, that really pushed us down. That's so far. An institution, a group of institutions, it could be a family office, a whole group of sovereign wealth funds, whoever the other time frame player is, that from an institutional standpoint, they're defending this area. They have been. It's very clear they're defending it. Doesn't mean they'll defend it next week, but for now they have. So what's that mean? That means that every time we've come up against this area, we've pulled back from it, to the tune in this case of about 50 cents each time. So here we sit, but we're coiling. So if you look at a daily chart, it came up. It's always easier to see in the capacity of the broader move, right? We came up against this area. We've pulled back. Top of this area is right here. This whole 94, 50-ish, 70 area, and we've pulled back. Haven't pulled back a lot, but we've pulled back. Now, does that mean we're coiling and looking to go up and break through again? Very hard to tell at this point. Right now, I would be accepting trades both sides until we break. If we break, these softwares are much smarter than I as far as calling out individual level trades on any currency, right? So continue to accept the trades if you feel comfortable with what's going on and you can afford to trade that capital, more importantly. Always be knowing what's going on from a broad perspective. You don't necessarily have to do anywhere near as deep of a dive as I do each week. That's why I try to condense it down with maybe a little bit of educational components to it. So that's DXY. Opposite situation, right? Euro come up into these areas, but we've seen significant weakness since the high levels of this 22-23 zone. And now we're holding on the edge of the cliff, a little bit higher. This is it. I mean, this total support's the exact opposite of what's going on with the DXY. So if we break this level significantly, I personally would not accept any trade that's showing me a long euro anything, right? But we have to decisively break this area, and that has not happened. So for now, I would just do two-way trades. This is GBP. Maybe a little bit easier to see. Much more in the center of its whole balance area, or its sideways trend that it has been in since, 9th of February, is it right? Yeah, so essentially since the beginning of February, we've been in this range. Bottom, so when we're in a range, you can continue to accept trades one way or the other, right? You don't have, at least typically, a statistical significance of one versus the other winning, right? You do when there's a big break of a long-term trend, as I'm always trying to talk about, but not while it's balancing in the center. USD CAD. Right in the center of a very broad balance area. It started December of last year, so almost a whole year. So this 120 area, bottom of the cliff, and then the top of this whole zone, which corresponds with a whole bunch of other currencies blasting off from some previously higher or lower range into the current one, just like you see here. This is being capped off at the top of just right under 130. So do note those zones. That is the CADness. Real quickly, this one has really continued to baffle me. So we broke out. I talked a lot about this in a training session, this candle pattern here where you come back down, support, some sort of doji shows its face within a couple of days of this. In this case, we're looking at a daily chart. Each candle represents a single day. So I would have this bouncing back off and then just, we moved higher. This is when you start getting nervous as an institutional player that is, really short the dollar or, essentially long the yen, right? Because it's almost like the complete head fake in the Japanese Nikkei and their equity markets led to a breakout of this. And people thought it was a head fake back in now, and then boom, it's just barbecued. Anybody that has been, you know, short the dollar, it's been kind of a crazy move. So you kind of got to go to a weekly chart, see kind of where we are, and over the course of 4 years, is that right? Maybe just narrow it down to the 3 years. The highest level we've been in 3 years. Much more strength in the dollar relation to the yen than we've seen in quite a long period of time. This is the only one right now that is truly breaking out into uncharted territory. Does that give us a clue that other currencies are going to follow? I don't know. But it is intriguing, to say the least. So that's why I've been talking about, and to a large degree, this could be the little birdie giving us a hint, if you will, right, that something really is wrong with China, because this country shares the other side of an offshore continent, right? Shares the other side of the area, I guess I should say. And if things really are going bad, maybe it's being reflected in the weakness in the yen. This whole 114.20-ish area is it. We are, for the first time in a long time, so let's count the times here. 9th of March, times we're outside the Bollinger Band, by the way, on a weekly chart. 31st of December 18, a little breach here. But look at these really protracted moves, right? They were reactionary. Now we know what this one's related to, obviously a pandemic. This one's related to some of the currency craziness that took place back then. A couple other events, including just concerns about Brexit, right? So it was more of a pin action thing on this currency from the pounds. But now, you know, we're outside the Bollinger Band again. I mean, we can count, not necessarily one, but I can only count 2 times realistically that we blew outside of it. I mean, significantly blew outside of it. So for those that want to take counter trades or step in front of the train, as I like to call it, from a weekly perspective, we are really overbought on this. There is an argument to take a counter trade. Dangerous, right? Only because I think we're going to zip up a little more, but even more so, you know, if somebody did have the patience for what I call an extreme trade, there could be a short to be had here. If you're a manual trader, trading discretionarily, you may want to take a close look at this. USD CHF. I never really have the best feel for this, but I want to at least show the chart on a daily perspective and weekly. Still inside the zone. 80 USD, daily again. This whole upper zone, and this looks just like a Euro chart, by the way, over a long period of time. We've been in this upper zone for over a year. CAD CHF, just a quick peek. Let's look at this on the daily chart. Let's take a look at Euro CAD, because this has having the same types of effects as that yen one I mentioned, but longer term, we're there. So we haven't been this low on this valuation of the euro in relation to the Canadian dollar since the spring of 17. So this is of note. There's some different things that are sort of acting up. The yen one's got me most intrigued. I think a lot of it has to do with ripples in what's going on in China, right? Could be wrong, but I think that they would be the first ones to suffer from just catastrophic meltdown in China. GBP CAD, Our old favorite Neo currency. Let's take a look at the daily first. So as I talk a lot about zones and breaking out of zones, I also talk about the importance of always being able to look back to see. Notice the big rally we've had off of, which was arguably the edge of the cliff on the daily. So there's a lot down here to support this hole just under bottom's right there. One spot 6874 zone. This whole little area. Big bounce off that. Hopefully Neo took advantage of that. What else? 80 CAD. Still holding that lower zone. Gold. You know, dollar falls. Now we're on the daily here. So this is interesting. So look at the big drop in gold prices, which just looks like it wants to send itself lower. And then jump between these two, or if you want to do a side-by-side chart, between spot and the dollar. So the interesting thing is typically when the dollar is going up, generally the trend, just looking at the spot market's down, right? And notice they both moved down on Friday. Different things going on. These are all kinds of clues, you know, and who knows? I could be just shining a light on an area. It doesn't matter. But I'm starting to, you know, just peel through to look to see clues of changes in correlations, right? Disrupted markets. Many of our markets are perfectly correlated, but there's always periods of time where they become uncorrelated. You know, and there's a zillion other charts that I could overlay. I don't want to blow everybody's head off their shoulders, but we could talk about that. We could talk about sentiment indicators. We could talk about oscillators, right? There's all different types of analysis of this, but in its very core, changes in correlations is typically your first clue. So oil, for those, this thing's probably going to see $85 sooner than later. Wouldn't be surprised if we saw $95. Supply chain issues. Let's take a look at crypto. Now, when you get to all-time highs, which is what it was, 64,895 on the 14th of April. So let's see what we've done. This candle a little bigger. Yeah, so the high was 62,944. I guess you could say it was close. So one step in front of the trade that I will always take, if a lot of other factors I'm always talking about fall in place, or at least the majority of them do. Remember, this business is always about one's ability to handle emotions, right? But it's also about, it's dramatically, in terms of a metrics or analysis standpoint, it is very heavily skewed towards the ability to deal with ambiguity, right? It's never going to be ding, 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 let's go short at the top, or, you know, the opposite move at the bottom of any kind. But if we come up against an all-time high, you almost always see, depends on how quickly, right? In this case, daily, you almost always see a reactionary trade against it. I will take that short against an all-time high. The first flash against it. Now, for those waiting for, is that number again? 60, so essentially just under 65, you missed the short. You know, I wouldn't wait for it to get that high again, right? I'd prefer to be front running the trade a little bit, right? You know, if you're, it seems crazy to say, but you know, if you're trying to catch the move in a very expensive coin, you could have put the trade in, as many of the smartest did, at the high, which is almost 1,000 points under, actually 2,000 points, right? So we were 63 at the high. So that'll be almost 2 G's less in the coin price, but you saw a pretty decent pullback. Where do we go from here? Tough to call, because a lot of the technical analysis that I have brought into this, I'd say I've been about 65 to 70% right. And that leaves, unfortunately, too much that I've been wrong about on this. for me to trust my analysis on it. There's other forces in play on this. And the big force that's in play is just the headwinds of acceptance, right? So you may have heard the news that Gary Gensler at the SEC, he's the new figurehead. We much preferred the previous SEC chair, but we won't get into that. But Gensler, who in my opinion is trying to make a name for himself, he's overworking the SEC, he's pissing a lot of the staff off. But what he is doing is he's shaking up the sort of willingness to play in the sandbox with these different crypto exchanges, right? The willingness to accept, which they haven't been willing to other than Grayscale, an ETF for this sector. So as many ripples or sandstorms, if you will, that's been taking place in this box, it's been a net positive for the space, right? So risk management 101, what are the factors that can affect the price of anything that trades? Regulatory headwinds is a big one. Okay, so that's what we're having in front of us right now. You can Google, Gary Gensler. You can Google anything that's going on in crypto land, and you will see there's some crazy headwinds from a regulatory perspective. That is, even though it is a storm, right? It's still a net positive for the coin space, and Bitcoin seems to benefit from that. So that, unfortunately, is a very difficult thing to forecast. So, but gun to my head, we pull back and probably blast off to the 75,000 area, and then all bets are off from that point, right? So we're coming into the end of the year, and then you're going to have other regulatory factors of whether all these knuckleheads in DC can get this bill passed, and will in fact our taxes go up. It's just not a smart move to do in a pandemic and a supply chain shortage. But we can never accuse our regulators and our politicians of being smart. Maybe with the exception of Reagan, he was a man. Now, outside of the another thing from a risk management standpoint you can do is always look to see what the other players are doing in a particular space, right? So if it's the metals, typically gold almost always lead the way, but occasionally there'll be a break from that, maybe palladium or some other metal like a silver will sort of lead the way or give you clues to what's going on. The clue I'm taking from the Ethereum trade, that it's nowhere near the highs. So does that tell me that Bitcoin's overdone and needs to pull back more? Possibly, right? If you take a look at some of the other coins, and none of these really even come even close, but they're under their highs and Bitcoin isn't, right? Now, one would say, well, it's being pushed up because, what if they get, full approval and there's, 6 or 7 ETF companies that come into the space like a BlackRock or some of these other guys, iShares from, ETFs, then yeah, sure. I mean, because, they're mostly just going to be buying Bitcoin, right? So it's going to bring pressure in from a purchasing standpoint to the pricing of this coin. So what do we care about Ethereum, right? So these are sort of the devils that I always play with myself back and forth, against each other of trying to determine who, rises to the top as far as most being right. It's a torment. So anyway, so that's the story. I don't want to bore you guys with any more of me jibber jabber. Hopefully took some good stuff out of this. In any time I watch any presentation online or I go live, even though I probably could teach the class that many of these people I listen to, I almost always pick up a couple of nuggets. In some cases, those nuggets are real powerful. So I always view any type of market presentation, not of, this person doesn't know what they're doing, or is what kind of nuggets can I take out of it, that in most every presentation I've seen has totally been the time that's worth it, unless it dragged on for days, which I can't do. I can't go to industry conferences and sit around and listen to the TD or Schwab guys rattle on for 3 days. It just drives me nuts. Plus, of course, they got a good dinner for us to go to. So that being said, everybody have a good weekend. May the trades be with you.